Have you ever really thought about how different kinds of wealth, well, interact, and what that actually means for your purchasing power, especially for big things like a house? Today we're doing a deep dive into something truly fascinating. It's the story of purchasing power evolution between Bitcoin and the U.S. housing market. So let's set the scene. Right now, Bitcoin, still the leader in crypto, is trading pretty solidly around $118,836. It seems to be holding quite well above that $118,000 mark.
hmm And these numbers, they aren't just abstract figures. They point to a maturing market. We're talking a market cap over, what, $2.3 trillion?
Yeah, and huge daily trading volumes, over $74 billion. That signals serious institutional and retail interest, the kind you need to be compared with traditional assets.
Definitely. And then you look at the other side of the coin, the U.S. housing market. It's showing that steady appreciation we've seen. Average home value around $369,000.
And the median hitting record highs about $435,300. So two major asset classes, both showing strength in their own ways.
Okay, let's unpack this a bit. Our mission here is to explore what we're calling the mathematics of transformation. Basically, the shifts in digital asset value and money dynamics. We're focusing on three key areas that really highlight how this evolution is playing out, and crucially, what it might mean for you.
Right. And what's really interesting, I think, is that these shifts aren't just about the prices changing. It's more fundamental. It's about how value is stored, how it's exchanged, how it's leveraged. We're going to try and connect the dots, show how these, well, very different assets have come together in some really unexpected ways,
Yeah.
especially in terms of buying power.
Yeah. And that convergence, it really starts with something that's almost, well, hard to wrap your head around.
Yeah.
The exponential wealth creation from digital assets. We'll begin by looking at the huge shift in how many Bitcoins it takes to buy a house now compared to, say, a decade ago.
Then we'll get into how regulatory changes have actually made Bitcoin more useful for real estate deals.
Yeah, the practical side.
And finally, we'll touch on how broader institutional adoption is creating maybe a more sustainable long-term value for Bitcoin. So let's kick things off with that first idea, the exponential wealth creation. Just think back to 2012. If you wanted to buy a median-priced U.S. home then, our sources say you'd have needed somewhere around 33,952 Bitcoins.
Yeah. Just pause on that number for a second. 33,952.
It's huge.
It is. And what's truly remarkable, maybe even staggering, is that today, for that same median home, you're looking at needing maybe 3 to 4 Bitcoins.
3 or 4, down from almost 34,000. That's an increase in purchasing power of about 8,400 times over just 13 years.
Like 8,400x. I mean, when you compare that to traditional investment returns, it's in a completely different league.
It really forces you to rethink the possibilities for wealth accumulation, doesn't it?
It absolutely does.
Yeah.
And it fundamentally changes wealth distribution patterns, too. Think about generational wealth. Maybe a millennial who got into Bitcoin early on. That appreciation could mean a down payment on a house that perhaps their parents, dealing with traditional savings, maybe student debt, could never have managed at that age.
Right.
It sort of short-circuits the conventional saving timeline. It creates this unique economic mobility for those early adopters, really across different demographic groups.
And it's not just the price going up that makes Bitcoin more relevant for real estate. It's also about the usability, right? How easy it is to actually use it in these deals. And that's where regulations come in.
Exactly.
Like the U.S. Federal Housing Finance Agency, the FHFA, now allowing potential buyers to use Bitcoin as part of their mortgage application. That feels significant.
Oh, it's huge. It's a monumental step. And then there are these new U.S. housing rules allowing Bitcoin and some other cryptos too to count towards mortgage reserves.
Mortgage reserves. Okay, why is that specifically so critical?
Well, because it tackles those friction points that existed before.
Huh.
Previously, if you wanted to use your crypto for a house, you often had to sell it first. That could mean an immediate tax hit or maybe being forced to liquidate at a bad time just to get the cash.
Ah, okay. So these changes mean you could potentially leverage your Bitcoin holdings for a mortgage or reserves without necessarily having to sell immediately and face those tax consequences.
Precisely. It avoids that forced liquidation event. It's a real paradigm shift, I think.
Yeah.
It validates Bitcoin as, legitimate collateral, a store of value that works within the traditional financial system, at least for this purpose. It's integrating crypto wealth into mainstream real estate in a practical way, changes the whole calculation for someone holding digital assets.
And this integration, this growing acceptance, it feels like it's also fueled by something else we've seen building momentum, broader institutional acceptance,
Definitely.
which seems to have fundamentally changed Bitcoin's risk profile, moving it perhaps away from being purely speculative. We've seen things like the Bitcoin ETF approvals.
Absolutely critical. The ETFs, the exchange-traded funds, they open the door for traditional investors. People who maybe weren't comfortable holding Bitcoin directly, now they can get exposure through their regular brokerage accounts. Makes it much more accessible.
Right. And you add to that big corporate buys, MicroStrategy being the famous example, and even some countries adopting it in certain ways. It all points towards sustained demand, doesn't it? Coming from these more traditional financial players.
It does. And that's a key difference from earlier cycles, which often felt driven more by, let's say, retail excitement or hype.
So you're suggesting these current price levels are reflecting more genuine utility and adoption,
Yeah.
that they're maybe better supported.
I think that's a fair argument. Look, when you have Bitcoin being integrated into corporate treasuries, potentially pension funds down the line, even sovereign wealth strategies, that provides a much more stable foundation. It offers structural support that just wasn't there in the early days. This leads to what economists might call more sustainable price discovery.
Sustainable price discovery, meaning the value is less about temporary sentiment swings and more tied to its actual use and long-term potential.
Exactly. The market, with all these diverse participants, is collectively working towards finding a more stable underlying value based on its perceived utility and place in the financial ecosystem.
So bring this all together, what does this really mean for you listening? We've seen this incredible transformation in Bitcoin's purchasing power relative to U.S. housing. It's driven by, well, that unprecedented appreciation we talked about, but also these key regulatory steps and this growing institutional backing. It paints a pretty clear picture. Digital assets aren't just a separate thing anymore. They're actively integrating into and maybe even reshaping traditional finance.
Yeah, and if you zoom out to the bigger picture, it really highlights a deep evolution in how we even define wealth, how we interact with it. It's not just about the traditional stocks, bonds, real estate anymore. It's about understanding this dynamic interplay with these new digital forms of value. And that raises a really important question for all of us, particularly when we think about long-term planning.
Indeed. So for you, the provocative thought to perhaps chew on is this. As digital assets like Bitcoin keep maturing, keep integrating into our financial world, how might this ongoing purchasing power evolution fundamentally reshape our ideas about long-term wealth planning, about property ownership in the decades still to come?